A lot of people believe that 5% is the magic number out there in order to move the housing market. But the reality is it's actually close to 6%. When we saw interest rates hit 6% last year, we saw a pickup in home sales. We saw a pickup in mortgage applications. And that's exactly what we're going to dive into in today's video. So Josh, you and I have been asked the question a million times, what rate's going to move the housing market? So today let's spend a little time and talk about it.
Yeah, there's two pieces to it, Jeb. There's the psychological component. It's shocking when you are aware, when you have people in your sphere who have a 2 handle on their interest rate at 2.875 or a 3.5, and you're being told it's 7.25 or 6.75. That's a big delta there, and it makes a massive difference in the monthly payment. I think the monthly payment is probably the more important piece of it. When we look at affordability, we talk a lot here on the show. Prices matter. Psychologically, people would like prices to be lower. But when people are making decisions, when households are making decisions, they look at how much of my household income is going to that monthly house payment. So the house prices are 50% of the equation. But the 50% that can move and can improve more is the interest rate. And we've seen it. So this year we probably got over 7% for a brief period. You look at the national averages, it was definitely over 7%. And right now we're in the 6.625 range. So that is the high part of the range where I personally, and I think all other mortgage professionals and realtors, start seeing a pickup in interest. And as you said, last fall, we got the preview where it went all the way down to 6%. We had some refinances that we did, no cost refinances under 6%. So we've been there. And you had said something interesting that application data picks up. Well, at 6%, it picks up right around where we're at right now, about 6.625, 6.5, and it accelerates. So it's almost undetectable to the naked eye. You're not going to look around your neighborhood and see additional activity. But for those of us who make our living with this, you notice a few more inquiries, people a little more interested, some people who are on the fence that really need to move but just can't get their brain around the numbers start going, okay, let's look at them. So it's important, and we have to look at what that's going to look like if and when interest rates get to 6%, so that it's less important exactly where it goes. Today we're talking about a lot of volatility and changes in sentiment in the market. It makes it more important than ever to have an advisor on your side. If we can help you on the mortgage side, on the real estate side, reach out to our team. We'll get you connected to someone who can walk through your specific scenario and not just talk in generalities like we do here on the show every week.
So let's talk about it a little bit, Josh. We've seen interest rates move down a 0.25% or so in the last couple of weeks. In fact, that 0.25% move was in about a week time frame. So we saw demand pick up from that. We saw calls, refinance opportunity, like just a lot. Like the lead gen side of our business kind of just picked up once those interest rates dropped. So why is 6% the trigger point? Why? Because again, we're talking people sitting in 2.5%, 3% interest rates. 6% is a big delta still, double, right? But there's been data out there that shows it doesn't need to get all the way back down to 4.5%, 5% in order for activity to pick up. We're actually seeing it quite a bit higher, closer to that 6% number.
If I were to run my numbers, Jeb, year to date, I do 2 to 3 refinances. And you compare that to COVID when everyone is in the money, when rates are so low that everyone should be refinancing, it's probably 15. So it's 20% of what that normal volume is. And it is
15 a month? Like what you said, 2 to 3. Okay, because
you
didn't explain what 2 to 3 was. So 2 to 3 a month.
2 to 3 a month. And when things are just insane, hot, on fire, for me personally, it's 15. If you're a kid in the call center, it might be 50 when rates are ultra low. But that gives you an idea. And those 2 to 3 this year have been 90% either cash out, which is need driven, or need driven like divorce, death, inherited a property, something along those lines where we have to do it. It's not a market opportunity driven. So over the last week, I think we've opened 6 refinances in 1 week, just since those rates dropping. And who are those people? They're not the people with 2 and 3% interest rates. There's no opportunity there. It's the people that bought late 22, 23, 24, some of them even the first part here of 2025, where they're at rates, if it's a conventional loan, they're in the mid to low 7s, 7.25 to 7.5. And if you can go to 6.625 and not pay anything for it, and you have a 5 or 6 or 700,000 or even larger loan, it absolutely makes sense. The government rates are even better. FHA and VA are always lower by 0.5 to 0.75%. So those people, if they're at 6.25, I have a client right now 6.25 on a VA loan, and we're taking them to 5.625, so a little over 0.5%. But it's $1 million loan. It's $450, $500 payment savings. So we're just at the tip of the iceberg. I don't have the number right in front of me right now, Jeb, but I think they say like 1.5 million U.S. households are in the money for a refinance right now, meaning a rate and term, opportunity-driven refinance. About 1.5 million households with rates as they sit today. If rates drop to 6%, I believe the number is somewhere between 5 and 6 million.
It's like
households.
4 million. Well, that's what ChatGPT said, right? I did a video.
Take it with a grain of salt.
Sure. Yeah. But I asked a similar question, and it said 1.5 million right now, around 4 million if interest rates were to drop 6%, just below 6%. So it's a big number, right? A huge amount of people, huge amount of demand, huge amount of opportunity. But even with that, Josh, recent survey came out. We saw it on Resi Club, I believe. I don't know who actually did the survey, but it said like 52% of people out there that are currently house shopping, if you will, or potential house shoppers, right? Maybe they have a house to sell or what have you, would now consider an interest rate at 6%. Whereas a year ago, or not even that long ago, the number was substantially lower. So people are now starting the pain of owning a house that no longer fits your needs, the pain of sitting in something that just no longer works, or sometimes sitting on the fence you haven't even bought. You're now willing to consider that rate that, you probably weren't willing to consider a year, 2 years ago.
Absolutely. So the figure there, it was 41% in just the first quarter of this year. They do the survey quarterly. So up 11% in 6 months, essentially. And did people go and say, hey, you know what? We were wrong. 6% is a really good interest rate. That 11% has said, hey, maybe I give up the dream of having a 4% interest rate, which I haven't I've given up the dream in 2025, probably in 2026, but it could absolutely happen again in the future. Rates could be as low as they were during COVID, but it would take a really large confluence of events. And people are kind of wrapping their mind around that fact. We're now 3.5 years away from those ultra low interest rates. And people are just going, this is the new reality. We saw, Jeb, a report from Moody's. Now, you and I got a chuckle out of the methodology, where at the peak back in 2022, Moody's said nationally home prices were overvalued by about 28%. And now they're saying it's only 8%. So why? Part of that's because interest rates have come down. Part of that is because incomes have come up. Home prices have flatlined in real terms, but not in absolute terms. They've still been going up. So home prices haven't really corrected, but incomes have, and interest rates have a little bit. So all of this comes back into play of just the psychology of what buyers are looking at. If you felt like you needed to buy in early 2023 and you go, these rates suck, I'm waiting for a 5.5% interest rate. 2 years later, you could have had another child. That's 2 years in an apartment, living with the in-laws in the basement. And you're just like, I can't. What I thought was acceptable then, or what I thought I was going to be waiting for, is no longer there. But again, 52% are at that 6% level. I will not buy unless rates get to 6%. So we have buyers out there. The issue that we're really talking about, Jeb, I don't think this is something that's going to goose sales prices a ton and push sales prices back up. It's going to push sales volume. We've had record low sales volume going back to like 1996, despite a much larger U.S. population. So per capita sales is as low as it's been since like the early 80s, when rates were 18%. So if we get rates at that 6% range, what it does is it brings volume back into the market. So you had mentioned refinances, not that they're super relevant here, but refinances react immediately to interest rate changes. Last week, we had an increase in applications for refinances of 18%, purchases up 2%. In the same interest rate move. This week, 28% and 1%. So refis, people go, that's opportunity based. I got to strike now. In 3 weeks, I can have a lower payment. Purchases, you got to wrap your mind around it. And we saw this last fall, where we had almost 12 weeks of week after week after week of rates going lower and purchase applications continuing to go up. People have to think about this, wrap their mind around it, run the numbers, talk to family, talk to their advisors, talk to their realtor. What is this looking like? So we're really 2 weeks into this little blip down in interest rates. We're still just above the high end of that range where we think it would make a difference. If we get that move down lower, what you will see is purchase applications continue to tick up week after week. And after a couple months, you'll start seeing purchase numbers increasing if we get rates approaching 6% like we did last year.
So our podcast is The Educated Home Buyer. So tell me, like, why does the potential buyer out there in the market, the potential person that's selling, maybe looking to buy, right, the move up buyer, why do they care what happens with home sales? They don't. I mean, do they? At the end of the day, they care about prices. They care about interest rates. So interest rates move down a little bit. Does that interest rate moving down put them in a tougher position on the buy side? More competition? Does it open up more inventory? I mean, I have my beliefs, but is this whole thing about home sales picking up, interest rates going down? Are we in for another run on appreciation, home prices getting further out of whack, affordability becoming a problem? What are your thoughts?
So I'm going to cite one of your favorite statistics. 75% of sellers are buyers. So we will have, I mean, that survey, I believe, the survey that Resi Club does, like 80% of the people that they survey currently own homes. So they're people saying, hey, I have a 2.5%, 3.5%, 4.5% interest rate. I need that 6% interest rate to move. So it should increase supply, but it's going to increase demand. So we're talking about the supply demand balance. I don't know that it makes a huge difference for the supply demand balance. And when things, whether you use Moody's number, 8% overvalued, when you look at affordability, where it's stretched to historical levels, people who aren't good with numbers will look at just the absolute dollar value of homes, median home prices, things of that sort. Whatever your preferred measure is, I don't think we're going to see much other than that increase in value or in volume, because what we're likely to see, more sellers, more buyers, keep that demand in line, and people are not super comfortable with affordability where it is. So we're not going to have bidding wars pushing prices to the moon. So some version of almost a Goldilocks outcome of prices kind of stable, more supply because more sellers coming to the market, but more demand absorbing that supply and keeping prices in that stable range.
I agree. I think much of the same. I mean, yeah, we're pretty much on the same page there. I think it definitely unlocks some people that are sitting on the fence that own property now, that are just, it's not that they're unwilling. They're just kind of looking for, again, that Goldilocks scenario where rates are a little bit more affordable. The right home pops up on the market. They make that move, right? I mean, I was in a 2.99% interest rate, Josh, just almost 2 years ago. And, with the idea that, hey, this is probably where I'm going to sit for an extended period of time. And then all of a sudden, not that long after getting that rate, an opportunity came up where a property that we wanted with bedroom, bathroom, bigger space for the kid, all of that stuff kind of hit harder than the payment. And that sounds crazy to people out there, but the reality is, people, again, buy emotionally and justify logically. There was a lot of logic going into that thought, but at the end of the day, emotion won over, and then the logic kind of fixed itself at the end of the
Let
day.
me throw this in here. There's logic of spreadsheet. Spreadsheet logic would say, Jeb, that's stupid. Stay right where you're at. The logic of three growing boys and their buddies in and out of not a small house, but smaller than what you have right now. That your logic, your brain is telling you this doesn't work. We just need more space. And I'm willing to pay a premium for that. You paid a premium in the home price from where you were, and you paid a premium in the interest rate, and you suffered almost all of that. The thing that I like about the story is it says, hey, we're not, I say we, Jeb has demonstrated that we don't just talk about this here on the show. You felt pretty strongly that home, although at a much higher price than what your current home was still a relative value. It wasn't going to dip. It was going to stay flat or increase, and it's increased. You've made a bunch of equity while you're there. We thought rates were at a high and probably not correcting back to where they were, but would correct. And you've been able to refinance twice and ride that down and looking for the next opportunity when we get another run lower to try and do it again to increase that affordability, decrease that monthly payment. So it is a pretty good insight into what most people are. Because while you were saying that, I was saying, well, who are we really talking about? Who's kind of going to be unlocked by lower interest rates? It's the first time buyer that bought a 1,200 square foot, 3-bedroom, 1-bath house. Now they have an extra kid. It's 4 years down the line. Their kids are bigger and they're going, I got to get out of here. So the cool thing is If they can make that move, now there's demand for a little bit of a move up home, a little bigger home. And now there's supply of that entry level home for a couple of newlyweds to, hey, 3-in-1 would be awesome for us. We would like that. So in a way, your family was that. You had the entry level that worked great for you, but as your family grew, wasn't perfect. And you got something, you were able to move up. So that's really the people that we're talking about. What we hear a lot, Jeb, in the comments section, in comments on the live show, what people will say is, well, I don't want rates to go lower because then home prices are just going to blast to the moon again. Would that be possible if we got 4% rates? Yeah, but I don't think that's the reality. We're really talking about 6%, and this isn't an explosion of sales volume or an explosion of demand that isn't also met with supply, additional supply from sellers selling into that market and that new opportunity. So I'm not super fearful either way. As a professional, like homeowners, you asked an important question. Do homeowners care if there's 4 million homes that sell this year or there's 5 million homes that sell? They probably do. They don't want it to be 5 or 5.5 million because that's sort of that manic market where it's really hard to get offers accepted and sellers are completely in control. But when we're at the very low end of that, it's bad for the economy all the way around. Housing is a major driver of the economy. When people buy new homes, they buy carpet, they hire contractors to paint, to put a new roof on, any number of things. They buy furniture, electronics, TVs, filters, all the way through the economy. And we've got none of that sort of accelerant, that flywheel moving over the last 2-3 years. So if you work at a furniture store, you may not think I care about how many homes sell, but your job's going to do a lot better if you're a salesperson at Living Spaces when 4.5 million homes sell than 4 million.
One of our goals here on the show is not only to educate home buyers, but to connect with as many of you as possible. The easiest way to do that is for one of you guys out there that's watching, finding value in the show, to share it with somebody that's going through that process, considering buying a home, potentially considering refinancing. Again, that helps us accomplish our goal of creating educated home buyers and also of growing the show. And while you're doing that, if you find any value at all, make sure you hit that thumbs up and consider subscribing to the channel. Well, you brought up an interesting point there. I mean, the data shows that if interest rates get down to 6%, you'll see a 14% increase in existing home sales. So right now we're somewhere around 4 million, right? So that's going to put us at what, 4.6-ish, somewhere in that ballpark, 4.7, somewhere in that number. But more importantly, you got a 5% increase in new home sales. So you'll have existing home sales pick up, you'll have new home sales pick up. So there will be that demand in the market. And again, it drives everything. It drives furniture. It drives, construction workers, all of that stuff, which puts money into the economy, helps the economy continue to move forward. Now, the one piece that we don't know what happens, Josh, is the Fed. We're changing out Fed members. We're getting some differences of opinions and in cuts and how many and how long it's going to take. That sort of thing can have a bigger impact on rates. We're not there yet. But it's one of those things that, in theory, like interest rates go lower quickly, you could see demand pick up even further and drive home prices up, home sales up, all of that stuff. But the reality is, I don't think that's going to happen. But I guess more importantly, what's the risk of waiting at this juncture in the market?
Really, I don't even like that idea of risk of waiting. People use it, the cost of waiting. And there's several different softwares in the mortgage arena that will say the cost of waiting. Well, the cost of waiting assumes certainty in what's going to happen going forward. None of us have certainty. You and I get together here once a week on the podcast, once a week on the live show, and talk about what we think is going to happen based off of the data that's been presented. The issue is almost all of those cost of waiting analysis use historical figures. Over the last 40 years, home prices have appreciated X. Well, who cares? In 2008, they dropped 20%. In 2020, they went up 20%. You can't model that. You can't map for that. Unless your software is doing a Monte Carlo analysis where it runs 100,000 simulations and comes back and says with a 92% probability, this is what's going to happen. But no one does that because we don't have that type of precision. I think we're in a flat to stable market. I think rates are going to be improving. I don't think someone should be sitting here and waiting and going, I'm going to wait because at 6%, it's just a better situation for me. If you don't
waiting for the Fed to cut.
Yeah, the Fed, because the one thing I'm going to say is I'm going to push back. I think the Fed is an asymmetrical risk right now. They are not the thing that will drive rates lower because rates moving lower, The markets are watching exactly what the Fed is watching. So if the Fed is doing the right thing, however we define that, the market is watching the same data and making those moves ahead of them. If we get a much more dovish Fed, that we get a new Fed member, we get a new Fed president the first part of next year, if they suddenly get dovish and they're looking at data that the market says is mildly dovish and they're making monster cuts and bringing rates down because they're getting pressure from the White House, that's not a positive. That will drive mortgage rates higher. So there's a risk that they could throw things off the rails. But what we're hoping for, again, is a Goldilocks scenario where we've been a little bit too bearish at the Fed here, a little bit too scared. I was watching a video last night and someone had pointed out, they pulled up a video of Powell from June at the June meeting answering a question talking about, we haven't seen the impacts of the tariffs and they'll show up in the next 30 to 60 days. Well, here we are 90 days later and they're still saying, we haven't seen the impacts of the tariff. It'll show up in 60 to 90 days. So I have some charts I was digging through today to get prepared for the live show tonight, Jeb, and I'm looking at it going, yeah, there is an impact. It is much more muted than what people expect. And it is a one-time price shock. So after it's absorbed, it is what it is going forward. So from that perspective, we don't really have a crystal ball. I have some numbers in here. Where do homeowners expect rates to be in 12 months? 46% of homeowners expect them to be between 6 and 6.5. And we're just above that right now. So some degree of improvement. And if we factor in everyone who thinks it's below that, it goes to like 75% of people think 6.5 or lower. So better than we are today. Now, I happen to think another poll here of real estate investors probably have a little better pulse on this. They're actually betting with their dollars, not just sort of being asked a question. And they're at a much different number. 40% think it's between 6.5 and 7, which is essentially where we're at. 20% between 6 and 6.5. And the group below 6.5, if we aggregate those all together, we're talking like less than 50%. So we're still in an area where we believe that rates are going to move lower. Probably going to be slower than everyone wants, probably less impacted by the Fed, probably shouldn't be the most important part of your decision. What I would say is the people that we're refinancing right now that bought in the last year to two because it was the right time for themselves and they said, hey, I don't love this payment, but I'm going to write it down. That's the conversation I'm having with people. Hey, we've been able to make this payment. It's okay, but I don't love it. Another $300, $400, $500 savings to our bottom line makes it better. So I wouldn't say go out on a limb and take on a payment you can't cover or do a 2-1 buy down to make the payment fall under a range that you are comfortable with. So from my perspective, that's the decision that you're looking at. Don't do anything crazy. Don't do a buy down, temporary or permanent, to afford something that you can't otherwise afford. When we do believe that rates are going to move lower, whether it's this year, next year, the following year, all long-term projections are generally showing lower interest rates. We're not talking about 4% rates. We're not going to get $1,000 monthly savings. So be comfortable with what it is, but know that we're likely to move lower and factor that into your decision as it applies, but not as a thing that makes you comfortable doing something you otherwise wouldn't.
Yeah, and I think if you're somebody sitting on the sidelines, you're thinking, hey, interest rates come down, I'm going to get in the game. That's when I'm going to buy a house. Or maybe you're on the sidelines, you own a house thinking, hey, as interest rates come down, we're already considering it. That's what we're thinking. Just need them to hit there. Start the pre-approval process sooner than later. You need to know what the payment looks like at current rates, and then you'll have an idea of what it looks like as interest rates do move down. Gives you comfortability, lets you know, kind of where you are in the market. And more importantly, if something pops up, you're in a position to take advantage of it and you're not having to go back and do this stuff, in a stressful situation when you're trying to make an offer. So if our team can be of any assistance to you in that process, there's a link in the description of the video. You can talk with Josh and the team, go through the pre-approval process. If you've already gotten a quote, you can get a second quote just to assure that you're getting good numbers. We're able to help a lot of people not only save money that have already been pre-approved, but a lot of opportunities out there for refinances as well. So check that link in the description. And also, if you want to get in touch with a pre-vetted real estate agent anywhere in the country that works like I do, that same link will connect you with me, and I'll make that referral for you so that you're taken care of. But until next time, make sure you buy right, you borrow smart, and you build wealth. Adios.
Amigos.